What's up, guys, and welcome back to JodyFX. We are very much back with the Rougefx Blueprint to Trading Success. Pretty much going over the beginner, advanced, and masterclass way of understanding rule-based trading systems and really how to implement them throughout your life to the point to where it kind of creates a sort of balance so that you can grow on top of an already established foundation through, of course, experience as well as the assistance of a guide. It's very much possible to achieve consistency within the financial markets. As everyone here may already be familiar with, the Quasimodo QM pattern, that very much is a universal pattern throughout the really any kind of financial market. It is very much important to understand that this specific pattern isn't necessarily so prominent as to what it actually is, in whichever case doing, right? In whichever case it's reaching for liquidity and mitigation sequences. So where a lot of people may see this and see complete and utter confusion, profitable traders will very much see a weak high being liquidated. And if price decides to continue towards external range liquidity, completely shattering structural lows, we will understand this to very much be a liquidity grab. However, if price very much continues to establish higher lows, whether breaking structural highs or failing, swinging towards the lows, understand that the important thing that's very much going on is prices mitigating a mitigation sequence below it, liquidating liquidity towards the left and continuing higher towards higher prices. In whichever case, external range liquidity within that kind of range, right? So where a lot of people may just see a liquidity grab, a break of structure, pro traders very much see mitigation sequences, liquidity grabs, and very much that much more liquidity grabs depending on your very much ideal location within price action, right? In whichever case, your ideal scenario. I do appreciate every one of you for tuning in. I do appreciate every one of you who hit that like button, subscribe to the channel, because we do aim to upload very much consistently. There is a very specific reason why I started the video off talking about a QM Quasimodo and what that exactly pertains to overall market behavior. Well, the importance is pretty much being able to successfully get through the tiers of beginner, pretty much giving yourself a conscious introduction to the information being presented. In other words, the dot method, locating your range, your POI, the liquidity or inducement that is above or below, targeting the highest or most probable pool of liquidity and or target. It's honestly fairly simple, and we will very much have a video playing so you can very much understand what I mean. Understand that it's going to take a lot of hindsight testing. Understand it's very much going to take a lot of back testing as well, just to get you through the preparation phase in order to transition to more of an advanced approach to really understanding fractals within the financial markets. In this next, I guess you could say, phase, we're pretty much focusing on the range cycle from internal range liquidity to external range liquidity, from internal range liquidity into external range liquidity continuously, of course, and really kind of integrating or merging the concept of mitigation sequences and liquidity grabs, as well as price action inefficiency and rebalancing mechanisms, which very much we will go over the differences between all of these. It is also very much important to understand that there is an infinite amount of different scenarios that can take place within these markets. With that being said, yes, we do have a pretty obvious set of rules to really dictate a range, right? We definitely have in whichever this case, a protected low, weak high. We can very much assume and really anticipate price to retest, reach for internal range liquidity, as well as maybe this mitigation sequence, and very much continue towards external range liquidity. That's very much understandable. However, there is very much the offhand chance that price can definitely begin at a weak high and then gradually, right, with establishing a set of weak lows, work its way down towards internal range liquidity or fair value equilibrium of the overall order block that's being used as, in whichever case, a scaling opportunity, right? So in whichever case, price is very much reaching for internal range liquidity, leaving a set of weak lows just to liquidate, reverse, or in whichever case, shift on momentum and continue to set itself up for continuous liquidity grabs, really kind of instilling the fact that these lows are indeed higher lows and indeed protected lows. When looking to determine your mitigation sequences that are very much valid, as well as liquidity grabs, imbalance close price action inefficiencies, or rebalancing mechanisms, guys, it is important to realize that in this phase, we're working with imagination and anticipation, right? Now, we do all understand the QM at this point, right? But then we also need to understand QMs being used in ranges, right? So in this case, we have our protected high, weak low, right? Understand that this is going to act as our liquidity pool, or in whichever case, order block, depending or determining on the time frame, right? So if this is the 4 hour, this is going to act as a 4 hour bearish rejection block. Understanding that this is a weak low and a weak high is understanding that price has performed a liquidity grab very much in both directions. Now, before we, very much go forward, it's important to understand that in order to very much confirm a protected high, we very much need a break of structure of a major low. In order to confirm a weak low, we need a lower time frame, right? Understanding that the market is very much fractal and the QM is very much taking place on different time frames and different, I guess you could say, scenarios, perspectives, very much this, that, and a third. In order to determine your weak low to be valid, we need a simple liquidity grab, break of structure in the opposite direction. At that point, you can very much expect internal range liquidity to be met, our POI to be liquidated, and for our range cycle to continue towards external range liquidity. Now, understanding how to very much confirm a trading range, right? It is very much important to understand what's happening in between our liquidity pool, essentially, right? Very much understanding that our liquidity pool is going to be simply a weak high and weak low. It is very much important to understand that if you are looking to sell, it is very much important to understand that when determining your point of interest, or maybe you would be redefining your point of interest to the nearest breaker or rebalancing mechanism, or simply determining whether you are trading within a premium or discounted pricing, obviously determining if you were to be buying or selling. It is very much important to understand the opportunity that lies in between knowing the sensitive locations within, obviously, not only price action being obviously your candlestick or in whichever case order block within itself, but definitely what's lying in between, right? In whichever case, our liquidity grab opportunities. What do I mean by that? Well, as you can see, many times we will have price very much retest, reach for fair value equilibrium, or maybe it will reach for more of a premium pricing in order to continue towards lower or external risk liquidity in this case. However, what if you can change your perspective, right? What if instead of seeing a huge rejection block, or obviously in whichever case a liquidity pool, but very much a order block, a set of weak low, weak high? What if instead of that we could very much see our premium pricing area? What if I could draw my fib and really kind of measure this area in particular? What if I told you that without this specific Fibonacci tool measuring our premium area, if price were to tick along this specific Fibonacci sequence, we would very much get a mitigation or a type of mitigation of this overall rejection order block? What if I told you that in between our premium or discounted pricing area, we could very much use our Fibo, very much measure this specific area, point of interest, in whichever case, and really kind of understand the way price can very much provide us a liquidity grab and continue towards the lows? What if we could redefine our premium pricing area to a breaker block or rebalancing mechanism, and then we very much use our Fibonacci to measure that premium pricing area? Would it be fair to understand that price could definitely use this as a liquidity grab, provide us with a imbalanced fill of our previous break and retest, continue towards the high, use our mitigation sequence as a target in general, providing us with a clear liquidity grab, fulfilling our rejection block entirely, and then of course continue towards the lows? This is the difference between understanding a set of rules and understanding your set of rules through experience, hard work, perseverance, and really just a love and passion for the craft, of course, right? Now, what do I mean about all these technical ideals or concepts, maybe different notions, maybe even theories that I'm throwing out? This is essentially indicating that your order blocks are simply weak highs and weak lows. Your order blocks can very much be redefined, and the bulk of the volume within each order block, or again, liquidity pool, can very much be transferred over depending on where you are within price. So say you are very much working with a weak high, strong low situation, you would be looking for what? Discounted pricing, right? If price was very much down here, you would be very much looking for a rebalancing mechanism. If price was more so in this location, within this discounted pricing point of interest, we would be looking for what? Maybe a breaker play, maybe even a fair value equilibrium. In whichever case, price would be looking to mitigate our discounted pricing area, which in this case would act as a liquidity grab. Can you understand that? So your weak highs and weak lows will very much act as a significant point of interest, where price will tend to manipulate towards, either buy side, sell side liquidity. A lot of the times, price will very much mitigate the point of interest towards the left, reach for internal risk liquidity, and continue towards the highs, obviously, right? A lot of other times, price will disregard longs entirely and just continue the trend towards the lows, in whichever case you would have guessed a bottom, incorrectly. So really kind of trying to make this explanation as simple as possible. We have an OB, or point of interest. It's going to act as pretty much the sum of a weak high and a weak low. Understanding that anything in between the area is going to act as what? A liquidity pool. Understand that if price were to use the key levels, official key levels in whichever case, as a point of interest, understand that you would take that as a mitigation sequence. However, if price were to tag in between, in whichever case, understanding or grasping the concept of the fractal nature of the market, and understanding that within each point of interest or discount or obviously premium pricing, is another pair of discount and premium pricing, which is understanding that price can very much use the in-betweens of these point of interest as liquidity grabs. Not necessarily like that, right? Of course not, right? Usually it's going to come with a consequent of encouragement, and of course a consequent of encouragement, just to continue towards the highs or internal range liquidity. It really just depends on your overall range, right? So in whichever case, is price using this low as a mitigation, or is this low weak and we're just reaching for, a bulk or cluster of internal range liquidity, in which this case, weak highs to liquidate and continue towards, obviously, the lows, right? Expansion, correction, expansion. Now, with that being explained, it's no wonder why prices has the ability to really kind of get stuck at times and then break out, right? So in whichever case we're trending and then price enters a bit of a consolidation and then breaks out. Being a weak low, or maybe even mitigating a point of interest towards the left, continuing towards the highs, or whichever case, premium pricing. We get a significant push, and as you can see, price in whichever case provides a liquidity grab of a rebalancing mechanism position towards the left of, again, this bearish rejection block. In order for price to continue towards the lows, understanding that this is a liquidity grab in general is the understanding that price doesn't necessarily need to come back, correct? So only thing for price to really do is, create liquidity for itself, liquidate it. Create liquidity for itself, liquidate it, in order to obviously continue towards external range liquidity or a pair of slanted equal lows, right? Or really a weak low. Again, understanding that we are coming from premium pricing and very much targeting lower prices. Again, trying to cultivate the best price. Now, understanding price like this it really kind of gives you the ability to understand a good market versus a bad market. A good market will very much tend to trend. A bad market will tend to range. Not kind of assuming that, range markets are bad, or in whichever case, anything to be afraid of. It's just understanding that range markets they're going to tend to provide a false breakout a lot of the times and go the opposite direction. So with that being said, it's probably, again, important to understand and really kind of determine where you are in, or I should say within your point of interest. Now, when you understand that, all you need to understand is where is the candlestick with the highest amount of volume, right? I really do hope this is graspable to you guys very much looking and really kind of viewing this. Healthy markets very much are able to carry a healthy trend, whether we are dealing with a pretty significant expansion or a complete reversal within, of course, reaching for internal risk liquidity. Now, guys, when dealing with range markets, right, so in whichever case price is going to be consolidating within a pretty significant liquidity pool or the sum of a weak high and a weak low, it's very much important to understand that ranging markets must provide a break of structure of your initial liquidity pool before, obviously continuing your trend towards lower pricing, or of course, in whichever case, receiving that other leg of your expansion, correction, expansion, right? Now, what does that mean? This is pretty much understanding that, yes, we do have a weak high, weak low. However, we do have candlesticks, right? In whichever case, understanding that with these candlesticks, price is going to be, in whichever case, maybe holding out for a mitigation sequence, right, to take place, and then, obviously carry price towards internal risk liquidity, or price is essentially going to use that weak high simply as an inducement and very much consider this tiny candlestick tick a liquidity grab. And it'll be so subtle, the world will miss it, but it will very much be apparent, and it'll very much be there, and it'll be enough to carry price towards lower pricing. So, my friends, generally, what am I trying to get through to your psyche is your point of interest, whether it be, obviously the sum of a weak high and a weak low will help you identify a mitigation sequence from a liquidity grab and a continuation pattern from a reversal pattern. So basically, how do you identify if price is going to officially provide our break and retest? Well, I mean, there's not necessarily any kind of identification instead of really just anticipating what may or may not happen and really kind of exploring your options as well as opportunities that may or may not present themselves. So essentially, when you understand the significance of a candlestick shadow or wick, you understand that our weak high is going to essentially just act as a choke, and our official wick is going to act as our break of structure or major structural low break. Now, imagine taking this knowledge and applying it to a 4-hour chart. Really think about that. Now, imagine taking our point of interest, in this case being an unmitigated wick, very much measuring. In this case, price were to be providing yet another break and retest opportunity to leave liquidity, raid, continue towards the lows. The difference between a mitigation sequence that would have taken place if it had just, held at that fair value equilibrium from our continuation or trending from our continuation of our, obviously trending market towards lower pricing. This break will act as your choke. This break will very much act as your break of structure. Whether our equilibrium fair value is ticked as well as, reacted upon is dependent upon if we are very much dealing with a confirmation entry or a direct entry. In whichever case, a direct entry would probably look like an inducement, an equal high, a clean setup for a liquidity grab to continue towards the lows. Is it also possible for price to completely clear our point of interest in general just to continue towards the lows or lower pricing or maybe even external range liquidity? Yes, that's very much possible as well. Now, moving from our advanced to masterclass understanding of price action, of course, still very much being relevant when it comes to mitigation sequences, liquidity grabs, imbalances, rebalancing mechanisms, very much still being relevant. Very much you're going to have to understand price action to a significant level to really kind of hone in on your advanced level. That means very much understanding each candlestick, what it means to you, right, for yourself as an individual trader, right, as well as how does market structure really kind of come together in your mind, right? And of course, this will very much develop over time, and you will very much see very much more clear as you progress throughout your journey what exactly market structure is essentially telling you, right, or showing you or presenting to you, right? Now, when it comes to our masterclass, or really kind of understanding, in whichever case, Rougefx Trading style at a master or fairly significant level, is when you essentially put it all together, it just becomes the development of a maybe an intuitive notion in the back of your mind, in the back of your psyche, really kind of helping you understand what exactly you are continuously studying on the daily basis, right? And for, a lot of people, this really kind of solves the reason why we do this, why we continuously come to these charts and look for, or really look at market data and seek a higher knowing, a higher way of really kind of seeing these charts, right? Really kind of developing your awareness over time and integrating these patterns to a certain extent to understand where liquidity is as well as where it is essentially looking to or anticipating to really kind of magnetize toward. It becomes second nature, right? It just becomes something that your mind, your sixth sense, wow, your sixth sense very much persuades you to do, right? In this case, you're more so migrating from an imagination and anticipation kind of mindset to a deep knowing and a becoming kind of mindset. In this case, you are embodying your system. In this case, your system becomes a part of you or a piece of you, right? And in whichever case, you don't necessarily, like, don't get me wrong, very much write down your rules, understand your rules, and go over your rules. But you guys got to understand that when with trying to become a better individual or person in general, it has to come with change. And with change, evidently you're going to have to do something different, something that obviously stops a repeating cycle. Now, when the mind is presented with anything that's different or indifferent or maybe even intimidating to the I guess you could say ego, it likes to reject it. However, there is great healing and integration that comes with the acceptance of change, and more so the going with the flow of the natural order of things, right? And with really kind of understanding price action at a deep knowing and really kind of becoming your system or your profitable trading system, guys, you're going to very much have to pay attention to price action. You need to be able to pay close attention to detail. That's bodies and, or I should say, understanding body names and candlestick wicks, candlestick shadows, understanding the concept of what it means to mitigate a key level and what it means to liquidate a discount pricing area or a premium pricing area. What do I mean by this? I mean, well, what is a point of interest, right? What's a POI? A POI is the sum of a week high and a week low, correct? As you can see, we very much have a week low and a week high. If we take this point of interest and we measure it with our Fibo, it's important to understand that we have an area where price very much meets at a fair value equilibrium area. This fair value equilibrium area is the difference between a particular imbalanced close price action or imbalanced price action inefficiency, as well as maybe even a rebalancing mechanism, right? Now, why is it so important that I called out this very specific point of interest being a week or the sum of a week high and a week low? Well, this is essentially understanding the many or plethora of opportunity that takes place within our quote unquote QM, Quasimodo, or fractal. We'll call it a universal fractal pattern within the financial markets, right? Whether it be a liquidity grab of a week high, of course, whether it be the mitigation of a rejection block, or again, if we're really being honest, the transfer of our original order block or point of interest to our nearest rejection block, essentially, right? Which is going to lead to what? A fair value equilibrium touch, depending, of course, upon our Fibonacci. Very much also important to understand the difference between an imbalance within price, right? In this case, would act as would very much act as a breaker block play. Think of it like as a confirmation entry, or better yet, an imbalance price action inefficiency play. So a simple fill within price or break and retest within price to continue towards, we'll say, a slanted high. Again, of course, the difference between a breaker being used as a mitigation sequence and a rebalancing mechanism being used to rebalance price and really kind of acquire a significant direct entry. And this is very much understanding that we very much do have a weak low presenting itself as well as a weak high. And very much understanding that within our point of interest is another point of interest. And if price were to be residing within, this particular price level, in whichever case, this is just a diagram. So very much bear with me, just understanding that, within price is very much a weak low and a weak high. That is very much having the ability to be used as a fairly significant mitigation sequence, right? And as you can see, guys, what's taking place isn't necessarily a mitigation sequence. Of course, the overall order block or weak low, weak high opportunity can be very much used as a mitigation sequence, quote unquote, right? But in this case, in redefining our POI to, obviously, in this case, the nearest point of interest, which is going to act as, in whichever case we're talking about a imbalance, price action inefficiency, or rebalancing mechanism. Guys, as you can see, what's really happening is price is simply providing us with liquidity grabs, a liquidity grab. So it's very much, it's easy to understand why price didn't necessarily come back. And, you do that annoying thing where it liquidates a weak low in this case. Instead, price very much continued, shifted in momentum, retest, reached for liquidity, and continued towards its overall intended target. I hope you guys did very much enjoy this video. I hope this, in whichever case, interpretable, I guess you could say. I really wanted to break it down a lot of, I don't necessarily know, maybe you could say the Forex stereotypes the misconceptions of, I guess you could say falsehoods of trading or this industry, right? Pretty much going back over my work and really kind of understanding my trading system at a fairly significant degree or two. I've honestly come to the conclusion that, I mean, trading is not necessarily about having the right order block or even catching the right FU candle, right? But honestly, having the natural ability to become in sync with the markets, right? What do I mean by that? I mean, you can literally scale in whichever liquidity pool you are able to find, right? So you find a weak high, weak low, understanding that there's a protected high or low below or above your inducement. This is understanding that if you are able to very much practice, persevere, and really kind of hone in on your craft to its furthest extent, you can very much be able to transfer the liquidity within any liquidity pool, no matter where you are within price, no matter which price you are at. It's just understanding and really kind of focusing on the ability to naturally have an exit strategy. And for those who very much do need, I very much do teach about emergency exits in, I believe, one of my previous videos. However, most importantly, it's important to understand what makes your mitigation sequences validated, as well as what mitigation sequences are simply, liquidity. If you very much did make it this far in this video, be sure to hit this like button, subscribe to the channel because we do aim to post consistently. I do appreciate your support. I do appreciate your dedication to Rougefx trading system. This trading system is very much set to improve your overall win rate a significant amount. Will it be given to you? No. As of anything, it's very much earned. However, again, with hard work and a pretty good vision, guys, a vision of what you want and most definitely what you don't want, of course, within your reality, it's important to understand that anything is very much possible. Anything is very much possible. That's just assuming that you are able to believe that and not necessarily just talk it or walk it or maybe even think your confidence, but instead embody it, of course, right? I very much do offer mentorship through my membership program, as well as hourly 2-hour Roguefx trading sessions within our Roguefx private trading community. What's up, guys? For those who are very much wondering, going to be the differences between our different entry concepts, right? So very much going to be looking at our different mitigation sequence opportunities. We also very much have opportunities for different liquidity grabs to very much take place, right? So essentially, mitigation sequences are going to breed liquidity grabs, very much using this 3-count formation as an emergency exit. Liquidity grabs are going to magnetize toward mitigation sequences, right? So obviously, not only this mitigation sequence that very much is taking place towards the lows, or at least, obviously, these slanted lows, but as well as obviously below that, of course. We also have opportunities for imbalance close price action, as well as inefficiencies within pricing, right? So essentially, these are going to be lower time frame liquidity grabs. So if I were to draw my fib, as you can see, we were presented with an opportunity within our specific point of interest, very much acting as our imbalance fill. So again, if I take this point of interest and measure with my fib yet again, we end up receiving our mitigation sequence, quote unquote, right? But necessarily to be called a liquidity grab instead, just to really kind of differentiate. Now, of course, this would be an example of an imbalance price action inefficiency. However, understanding the difference between this and a rebalancing mechanism is understanding the difference between being able to take a trade and very much being able to miss out on a trade, right? So understanding your rebalancing mechanism is very much understanding that we very much are going to be presented with a weak low, weak high. Of course, we very much have a weak high above that we can very much use, but in this case, we can very much redefine to this specific weak high and weak low, very much mitigating a, it looks like a rejection block towards the left, assuming that price is very much printing out a QM to very much, of course, mitigate our rejection block or point of interest towards the left. Now, it's important to realize that the difference between an imbalance, again, imbalance, price action inefficiency, and a rebalancing mechanism is simply the understanding that we have the opportunity for a breaker block play. I guess you could say further on within price action, as well as an opportunity for a rebalancing, right? And when I talk about rebalancing mechanism, this is talking about price very much leaving a weak low that was very much liquidated, of course, right? Price provided a liquidity grab and continued the opposite direction, in whichever case, a shift in momentum. This is very much understanding the very much difference between an imbalance, price action inefficiency side of initially this measurement of our Fibbo, as well as a rebalancing or opportunity for a rebalancing mechanism, which is essentially the liquidity grab, or I should say series of liquidity grabs, essentially taking place, based off of our measurement of our Fibbo, right? Fibonacci sequence, right? So we got a tick, 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 really kind of assuming price to continue higher lows, as well as continue towards, external risk liquidity in this case, or a continuous expansion. Until next time on Jody FX.